Here's a brutal truth that will save your trading career. Jesse Livermore made more money sitting still than most traders make in a lifetime of frantic activity. But before he mastered this million-dollar secret, one catastrophic mistake nearly destroyed him forever. October 1907. Wall Street is collapsing. Panic selling everywhere. The air thick with fear and desperation as fortunes evaporate in real time. Jesse Livermore, already worth millions at just 29, watches stock prices crater like dominoes. His pulse quickens. His instincts scream one message: buy the dip. This looks like the opportunity of a lifetime. Steel stocks down 30% in days. Railroad shares obliterated. Banking stocks trading at fractions of book value. Every fiber tells him this is temporary madness. The market has gone too far. Time to be greedy when others are fearful. So he does what every amateur does when faced with apparent bargains. He buys, again and again. Each bounce, he adds more. Each false rally, he pyramids his position. Union Pacific recovers from $85 to $95. He doubles down. Steel Corporation jumps from $20 to $25. He loads the boat. His reasoning seems flawless. World-class companies at fire sale prices. The result? He lost $3 million in 3 weeks. In 1907 dollars. That's roughly $100 million today. Gone. Wiped out by the very market he thought he understood better than anyone alive. His carefully accumulated fortune, built through years of disciplined speculation, evaporated under relentless selling pressure. But here's where amateurs and professionals diverge forever. The amateur would blame external forces: market manipulation by big banks, unfair selling by foreign investors, panic by weak-handed retail traders, anything except their own decision-making process. Livermore did something radically different. He studied his failure with surgical precision. He dissected every trade, every decision, every assumption. What he discovered became the foundation that would make him over $100 million by 1929. The secret wasn't in buying or selling. It wasn't in market analysis or chart reading. It was in the waiting. Your biggest enemy isn't volatility or manipulation. It's your own need to act when the market demands patience. This revelation transformed everything about how Livermore approached markets. He realized successful trading isn't about constant activity. It's about identifying rare moments when conditions align perfectly, then acting with decisive conviction. The market rewards patience more generously than any other virtue. But patience remains the rarest quality among traders. Most confuse activity with progress. They mistake busy work for productive work. They treat boredom as a threat instead of opportunity. Picture this identity split you must internalize. The amateur reacts to every price movement like a moth to flame. They fear missing out on every potential opportunity. They trade on emotion, hope, gut feelings. They view cash as dead money earning nothing. They buy because it's down, sell because it's up. The professional operates from an entirely different paradigm. They respond only to confirmed conditions meeting predefined criteria. They treat cash as a position offering infinite possibilities. They trade on evidence, not emotions. They understand the market's job is separating them from money. Their job is making that separation difficult. Consider two traders watching the same stock grind between $40 and $45 for 3 weeks. News says value. Social feeds chant, oversold. Trader A buys at $42 because it looks cheap. He fears missing the turn. He places a stop loss at $40, then moves it to $39 when price dips, eventually removes it entirely just until it bounces. Trader B waits. She marks $46 as the pivotal point where real buyers must reveal themselves. She sets alerts, not orders. When price pushes $46 on volume surge, she still waits for confirmation. Next day it holds above $46, prints higher lows, broader market trends with it. She takes a starter position, risking 0.5% of equity. 2 days later, tight pullback on light volume offers her add point. The move to $65 looks obvious in hindsight. Only one got paid. Cheap isn't strategy. Confirmation is. The professional trader's most powerful weapon isn't speed or sophisticated software. It's restraint. The ability to watch apparent opportunities pass without regret. The discipline to wait for their pitch instead of swinging at every ball. In trading, what you don't do often matters more than what you do. After 1907, Livermore rewrote his approach completely. He treated fear and greed as signals about the crowd, not commands for himself. Cash became a position, not penalty box. Waiting became deliberate trade with positive expectancy. He wrote protocols: no entry without confirmation, no pyramiding unless paid by price, no averaging down, no opinion without tape evidence. This sounds cold. It's humane to your future self. The man who once chased every bounce would soon sit through entire campaigns because the signal was finally clean. He learned that professionals plan for error. Amateurs plan for victory parades. Here's the maxim that changed everything. There are times to go long, times to go short, and times to go fishing. The master trader knows the difference. Most traders never learn this difference. They treat every session like Christmas morning, unwrapping potential trades that usually contain disappointment. You're about to learn the exact four-part waiting game that transformed Livermore's greatest failure into his most profitable strategy. Wait, verify, strike, sit. 4 moves that separate legends from statistics. But first, you need to understand how the market's own language reveals when waiting transforms into action. The tape confesses everything if you know how to listen. Amateur traders try to predict the future. They chase hot tips from newsletters, devour financial headlines searching for hidden meanings, and attempt to call exact tops and bottoms like fortune tellers reading crystal balls. This isn't trading, it's gambling dressed in analytical clothing. Livermore discovered something infinitely more powerful after his 1907 disaster. The market speaks constantly through price and volume. He called it reading the tape. His genius lay in listening to this language, not trying to dictate it. The tape doesn't lie. It can't be manipulated by press releases or analyst upgrades. Price and volume represent the collective judgment of every participant risking real money. When this judgment shifts decisively, the tape broadcasts the change to anyone willing to listen without prejudice. After his devastating loss, Livermore made a revolutionary discovery that would reshape his entire approach to speculation. He identified what he called pivotal points, precise moments when a stock breaks character with unmistakable conviction. These aren't arbitrary lines drawn by chartists hoping to impose order on chaos. They're the market's own confession that something fundamental has shifted, that a new trend is beginning whether participants realize it or not. When institutional money finally reveals its hand, the tape screams this conviction through volume and price action. Your job is becoming a translator, not a predictor. Consider this scenario that separates amateurs from professionals daily. United Steel has been grinding between $40 and $45 for 6 grinding weeks. The range has been tested multiple times. Buyers emerge near $40. Sellers appear near $45. The stock looks trapped, boring, dead money to momentum chasers who've moved on to more exciting opportunities. The amateur sees it trading at $42 and thinks cheap. Relative to the recent high of $45, it looks like a bargain. News flow suggests the company is undervalued. He buys immediately, congratulating himself on getting a quality company at a discount. His stop loss goes at $39, giving the position room to breathe. He operates on hope disguised as analysis. The professional operates from an entirely different framework. She marks $46 as the pivotal point where real institutional buying must reveal itself. Above this level, the stock would be making new short-term highs, breaking free from its established prison. She sets price alerts, not orders. She waits with the patience of a sniper for the market's confession. 3 weeks pass. Steel continues its sideways grind. The amateur's position moves from small profit to small loss, to break even, and back again. He checks it constantly, wondering when his value will be recognized. Meanwhile, the professional monitors dozens of similar setups, waiting for one to speak clearly through the tape. Then, it happens. On a Tuesday morning, steel gaps to $46.50 on 3 times normal volume. The breakout is decisive. not tentative. Real money is finally expressing conviction, but the professional still doesn't act. She needs confirmation that this isn't a false breakout designed to trap eager bulls who mistake noise for signal. The next day provides her answer. Steel opens higher, pulls back to $46.10, then surges to $47.80 on expanding volume. The pivotal point is holding. Buyers are defending their breakout level. The tape is confessing that accumulation is occurring above $46. This is her signal to act with conviction. She takes her starter position at $47.20, risking 0.5% of her trading capital. Her stop sits just below $46, the pivotal point that must hold for her thesis to remain valid. The amateur who bought at $42 might save $5 per share on his entry, but he's operating without a plan, without confirmation, without the tape's blessing. The move to $65 unfolds over the following weeks. The professional captures most of it because she entered with the trend's momentum, not against it. The amateur gets shaken out during the first pullback to $44 because he bought hope instead of evidence. One traded on confirmation, the other on assumption. Livermore's protocol was surgical in its precision. Clear support and resistance levels tested at least 3 times. These levels must be obvious to any objective observer, not requiring complex analysis or subjective interpretation. The market itself draws these lines through repeated price rejection. Decisive move beyond the range on above-average volume, specifically 150% or more of the 20-day average. Volume confirms that real money is behind the move, not just short covering or algorithmic noise. Without volume, breakouts typically fail within days. Price must hold above the breakout level without immediately reversing. Many breakouts are false signals designed to trap the unwary. True breakouts attract follow-through, buying that defends the new price level. This confirmation phase separates real opportunities from market noise. Buy when the stock shows it wants to go higher, not when it's falling back toward the breakout point. Buy rising prices, not declining ones. This seems counterintuitive to value-oriented thinking, but momentum creates momentum in liquid markets. His maxim became legendary among those who understood its profound implications. Never buy a stock because it has had a big decline from its previous high. Wait until it starts to go up. This challenges everything amateur traders believe about value and opportunity. This sounds completely counterintuitive to conventional wisdom about buying low and selling high, but Livermore understood that cheap can always become cheaper. Falling knives have no bottom until they find one. A stock plummeting from $100 to $50 might seem a bargain, yet without clear confirmation of an upward trend, it could continue its descent to $25. Waiting for confirmation meant missing the absolute bottom, but capturing the real move with dramatically reduced risk. The beauty of this approach lies in its objectivity. The tape eliminates opinion, hope, and fear from decision-making. Either the pivotal point holds, or it doesn't. Either volume confirms the breakout, or it doesn't. Professional traders think in if-then statements. If price breaks the pivotal point on convincing volume, then take a measured entry. Amateurs think in because statements. Because it's down, buy. Because it's up, sell. One is protocol. One is impulse. One keeps you in business. The tape tells you when conditions are right for action. Price tells you exactly where to enter and exit, but knowing when and where means nothing without answering the crucial question. How much should you risk when the market finally confesses its intentions? That's where mathematical precision becomes your survival tool. While Wall Street burned in 1929, Jesse Livermore was sitting on the trade of his lifetime. But it wasn't because he predicted the crash through mystical foresight or insider information. It was because he had mastered position sizing and pyramiding, the mathematical art of being small when wrong and massive when right. This distinction separates legends from footnotes in trading history. Here's the professional's paradox that destroys amateur traders daily. Your biggest profits don't come from being right more often than you're wrong. They come from being right bigger when you're right. Most traders obsess over win rates, celebrating 60% accuracy while their accounts bleed from poor risk management. Livermore's 1,929 fortune wasn't built on dozens of small wins scattered across multiple positions. It was built on carefully scaled positions that he held through the entire market collapse, adding systematically as conditions confirmed his thesis. The mathematics are brutal in their simplicity. 10 trades risking 1% each. Winning 6 and losing 4 nets you roughly 2% if winners equal losers in size. But one trade risking 0.5% initially, scaling to 3% total as the market validates your position, can return 30% or more. The difference between systematic wealth building and account grinding lies in this mathematical reality. Picture this scenario. You're short Radio Corporation at $100 after a confirmed pivotal point breakdown. The stock has broken below a 6-month trading range on 180% of normal volume. Your initial position risks exactly 0.5% of your $1 million. Trading capital, that's $5,000 with a stop at $102, just above the breakdown level that must hold for your thesis to remain valid. 2 weeks pass. Radio Corporation drops to $90. Amateur thinking screams with dopamine-fueled urgency. Take the $10 profit. Lock in the win. Don't let a winner become a loser. This voice represents everything wrong with retail psychology. It treats each trade as an isolated lottery ticket, rather than part of a systematic wealth-building process. Professional thinking operates from an entirely different framework. It whispers with cold mathematical precision. If I'm right about this trend change, this $10 move is just the beginning. The real money comes from riding major moves to their logical conclusion. The amateur grabs quick profits that feel emotionally satisfying. The professional engineers asymmetric returns through disciplined scaling. Livermore's sizing protocol was mathematical, not emotional. Initial position. Risk only 0.5% of total capital on first entry after confirmation. If you manage $1 million, your initial risk is $5,000 full stop placed where the thesis dies, not where it hurts. This ensures that even if immediately wrong, the loss won't materially impact your ability to take the next high probability setup. Add only when the market pays you through fresh breakdowns accompanied by volume expansion of 150% or more above the 20-day average. Never add to losing positions hoping they'll reverse. Only add when price action validates your original thesis through continued movement in your favor. This is the opposite of averaging down, which amateurs use to feel better about being wrong. Move stops to protect gains as you add, but never increase total portfolio risk beyond 1% on any single idea. As Radio Corporation fell from $100 to $90, the original stop moves from $102 to $100, locking in break-even. This allows adding a second unit, risking another 0.5% while maintaining strict risk control. Never exceed 3 to 4 positions of this size simultaneously. Even the best setups fail occasionally. Concentration builds wealth, but over-concentration destroys it. Diversification across a few high-conviction ideas provides protection while maintaining meaningful profit potential. Radio Corporation continued its relentless decline from $100 to $20 over the following months. That single position, properly scaled through systematic pyramiding, generated over $8 million in profits for Livermore. But here's the crucial detail amateurs miss. He didn't just hold blindly hoping for the best. He added systematically as market conditions confirmed his thesis through specific, measurable criteria. New closing low with volume higher than the previous 3 sessions. This confirms selling pressure is intensifying, not diminishing. Fresh institutional liquidation is occurring at lower prices, validating the breakdown thesis. The stop on the original position moves to the breakdown level, protecting profits while allowing room for trend development. Failed bounce that stalls below the original breakdown level. When Radio Corporation rallied from $85 back to $95 but couldn't reclaim $100, this failure confirmed that former support had become resistance. Failed bounces in genuine trend changes provide ideal second entry points, with stops now protecting both positions. Only if volatility contracts, while price continues declining. This indicates panic selling has been absorbed by strong hands, yet the downtrend continues methodically. Reduced volatility with continued downward pressure suggests institutional distribution rather than emotional retail selling. This provides the highest probability addition point. The maxim that generated millions became legendary. Cut losses fast, but let profits run with mathematical precision. Most traders get this exactly backward. They hold losers hoping for recovery while cutting winners to lock in small profits. This guarantees long-term failure regardless of analytical skill. The amateur versus professional identity split becomes crystal clear in position management. Doubles down on losing positions to feel right about their original analysis, then takes profits quickly to feel safe and smart. Every decision is driven by emotional comfort rather than mathematical logic. Adds to positions only because the market proves them right through continued favorable price action. Then holds because the trend structure remains intact. Every decision follows predetermined protocols based on probability and mathematics. They treat trading like a business, where systematic execution generates consistent returns. But there's a dark psychology to holding large winning positions that nearly destroyed even Livermore during his later years. When a position grows from 0.5% risk to 3% of your account value in profits, your brain begins playing dangerous games. Fear of giving back gains battles against greed for larger profits. Your mind screams to act when systematic patience demands stillness. How do you sit tight when every instinct tells you to grab the bird in hand? Here's the most counterintuitive truth in trading. Sometimes your best position is no position at all. After his monumental 1929 triumph, where he systematically turned market panic into over $100 million, Jesse Livermore believed he had permanently mastered the waiting game. Success breeds dangerous confidence, and the man who had patiently waited for perfect setups during the crash began chasing every marginal opportunity. By 1934, his impatience had returned with devastating consequences. He started overtrading, abandoning his patient approach for the intoxicating action of constant market participation. Every small pullback looked like a buying opportunity. Every minor breakdown seemed worth shorting. The systematic approach that built his fortune was gradually replaced by impulsive decision-making, disguised as experience. The result? Complete bankruptcy. The same man who had turned market panic into systematic millions lost everything not through bad analysis or poor timing, but through the simple inability to sit still when the market demanded patience. Why does waiting become so psychologically torturous that it destroys even masters? Because it triggers our deepest evolutionary fears that once meant survival. Fear of missing out on scarce resources whispers constantly that perfect opportunities are happening without you. Fear that perfect setups will pass by forever creates anxiety that opportunities are fleeting and finite. Perhaps most powerfully, there's the fear that cash is dead money, earning nothing, while others get rich. These fears served our ancestors well when resources were truly scarce, but they destroy modern traders who mistake activity for progress. The amateur surrenders to these fears completely, treating every day without a trade as wasted time. Every move they don't catch as personal failure. They confuse busy work with productive work, treating their trading account like a video game demanding constant interaction. The professional weaponizes patience itself, understanding that waiting is not passive but the most active thing you can do in markets. While amateurs exhaust themselves chasing noise, professionals conserve energy for genuine opportunities, treating cash not as dead money, but as ammunition waiting for the perfect target. After his 1934 disaster, Livermore developed what he called emotional stop-losses, rules specifically designed to protect against his own psychology rather than market moves. These weren't price levels on charts, but behavioral guardrails preventing emotional decision-making during vulnerable psychological states. After any loss, he imposed no new trades for 24 hours minimum. Losses trigger fight or flight responses that cloud judgment longer than most traders realize, and the urge to get even immediately leads to revenge trading on marginal setups. This mandatory cooling-off period allowed emotional equilibrium to return before risking capital again. After big wins, he reduced position sizes by 50% for the next 3 trades. Success triggers dangerous overconfidence, leading to oversized bets on marginal setups, as the dopamine rush from big wins creates false certainty that everything you touch turns to gold. Smaller sizes during these periods protect against euphoria-driven mistakes while maintaining market participation. During unclear markets, he treated cash as a position, not punishment. When market conditions don't meet criteria for high probability setups, sitting in cash becomes your highest probability trade, reframing waiting from missing out to making the smartest available decision given current conditions. Consider this scenario, separating amateurs from professionals daily. You've identified what appears to be a perfect pivotal point setup after weeks of analysis. The stock approaches your predetermined entry zone, and excitement builds as your setup develops exactly as planned, but something feels off. Volume during the approach is unusually light, barely 70% of the 20-day average. The broader market is chopping sideways without clear direction. Your gut, trained by years of observation, whispers uncertainty, despite analytical confidence. Amateur thinking screams with urgency. This is it. The setup you've been waiting for. Don't miss this. This voice represents everything dangerous about retail psychology, treating each potential setup as the last opportunity that will ever present itself. Professional thinking whispers with calm certainty. The setup looks good, but conditions aren't pristine. Light volume suggests lack of institutional conviction. Wait for better conditions. 2 days later, your patience pays off. The stock breaks your level on 200% of normal volume as the broader market begins trending clearly higher. Your patient entry captures a clean 15% move over the following week, while the amateur who jumped early got stopped out during the initial fake breakout you correctly identified as suspicious. Transform waiting into systematic protocol rather than emotional endurance. Each morning, perform a pre-market scan, identifying 3 to 5 potential setups and set alerts, but place no orders. This preparation focuses attention without committing capital prematurely. At market open, observe price action and volume patterns, but act only if conditions are pristine, volume exceeding 150% of average, broader market cooperating, and your intuition feeling confident. Most days won't meet these criteria, and that's perfectly acceptable. By midday evaluation, if no clear signals have emerged, close your trading platform and walk away. The afternoon often produces choppy, directionless action that tempts marginal trades, and removing temptation protects against boredom-driven mistakes. End each day reviewing what you didn't trade and why, building pattern recognition for identifying optimal conditions versus marginal setups. Over time, this discipline creates intuitive feel for when markets are ripe for action versus when patience serves you better. Livermore's ultimate maxim crystallized this wisdom. There are times to go long, times to go short, and times to go fishing. The master trader knows the difference. Most traders never learn this crucial distinction, treating every session like Christmas morning, unwrapping potential trades that usually contain disappointment rather than profits. The professional versus amateur mindset becomes crystal clear in how they view inactivity. Amateurs treat waiting as wasted time where nothing productive occurs, viewing cash as missed opportunity, earning nothing while others get rich, unable to tolerate boredom without taking action to feel productive. Professionals treat waiting as active strategy, positioning them for optimal opportunities, viewing cash as ammunition, providing infinite possibilities when conditions align perfectly, understanding that capital preservation during uncertain periods enables maximum aggression when certainty emerges. The complete framework is finally coming together through these interconnected principles. Reading the tape for timing, waiting for confirmation, sizing mathematically, and weaponizing patience. But how do you execute flawlessly when all elements finally align and the perfect storm arrives? Now you possess every piece of Livermore's waiting game, the same framework that could have prevented his $3 million disaster in 1907 became the systematic approach that generated over $100 million in 1929. Let's close the loop with the exact playbook that turns market panic into mathematical profits. This isn't theory, it's the step-by-step framework that works in any market, any time frame, any condition, transforming the amateur's greatest weakness into the professional's ultimate weapon. Battlefield mapping begins with surgical preparation that eliminates emotion from opportunity selection. Identify 3 to 5 liquid stocks showing clear range patterns where institutional money has established obvious support and resistance levels, tested at least 3 times each direction. These ranges must be apparent to any objective observer. not requiring complex analysis or subjective interpretation. Mark pivotal points precisely where breakouts would confirm genuine trend changes. These levels represent where stocks break character and reveal new institutional intentions. Set volume alerts at 50% above the 20-day average at these critical levels, ensuring you're notified only when meaningful money starts moving, not just algorithmic noise. Calculate position sizes mathematically. 0.5% risk per individual setup, with maximum 2% total portfolio exposure across all positions simultaneously. If you manage $100,000, your initial risk per trade is $500, with total exposure capped at $2,000. This ensures that even if every setup fails immediately, your account suffers manageable damage while preserving capital for future opportunities. Confirmation. Waiting separates professionals from amateurs when breakouts finally occur on elevated volume. When your stock breaks the pivotal point with conviction, resist every instinct screaming to act immediately. Do nothing yet. Wait 1 to 3 sessions for either retest of the breakout level or continuation with sustained institutional participation. Many breakouts are false signals designed to trap eager participants who mistake noise for genuine trend change. Enter only when 3 conditions align perfectly. Price holds decisively above the breakout level without immediately reversing. Volume remains elevated above your predetermined threshold, and the broader market cooperates by trending in the same direction. Place your initial stop just below the pivotal point that was broken. This level must hold for your thesis to remain valid. If price returns below this level, your analysis was wrong and capital preservation becomes paramount. Professionals buy strength with protection. Amateurs buy weakness with prayers. Systematic scaling transforms good entries into extraordinary profits through mathematical precision, never emotional attachment. Add only when the market pays you first, proving your thesis correct through continued favorable price action. When the stock makes a new high or low close with volume expansion exceeding the initial breakout, add your second unit while moving the original stop to break even. This eliminates initial risk while building position size as probability increases. When counter-trend moves fail and stall below key levels, add your third unit while trailing stops below recent swing points. Failed bounces in genuine trends provide ideal addition points with favorable risk-reward ratios. Only when the trend continues with contracting volatility, suggesting institutional accumulation rather than emotional retail participation, add your final unit while trailing stops with a 2 times average true range buffer. This systematic approach builds position size only as the market validates your original analysis, never averaging down into losses but scaling into strength as conditions improve. Professional exit requires the same discipline used for entries, treating profit-taking as systematically as loss-cutting. Cover 1/3 of your position into acceleration phases or volume climaxes when euphoria reaches extreme levels. These moments often mark temporary exhaustion points where taking partial profits makes mathematical sense while maintaining meaningful exposure. Trail the remainder with moving stops or technical levels that respect the trend structure, allowing maximum profit extraction while protecting against sudden reversals. Execute full exit when the trend structure breaks definitively, or new pivotal points form in the opposite direction, signaling potential trend change. Never hold positions based on hope or attachment. Exit when conditions no longer support your original thesis, treating each decision as independent of emotional investment. The 1929 example demonstrates this framework's devastating effectiveness during history's greatest market panic. Livermore identified distribution patterns in leading stocks like Radio Corporation and General Motors, then patiently waited for confirmed breakdowns below key support levels on massive volume. He entered short positions systematically using this 4-phase approach, added on failed rallies that couldn't reclaim broken support, and held through the entire collapse while scaling profits appropriately. His patience and systematic execution turned a $10 million account into over $100 million during 18 months of relentless decline. This wasn't luck or prediction, it was mathematical precision applied to human psychology during extreme conditions. The master's maxims crystallize everything into memorable principles. Wait, verify, strike, sit. 4 words containing the essence of professional speculation. Cash is a position. Patience pays compound interest. Reframing inactivity as strategic positioning rather than missed opportunity. Cut losses fast. Size small. Add only when paid. The mathematical foundation, ensuring long-term survival and prosperity through systematic risk management. The final amateur versus professional identity contrast becomes crystal clear in execution. Seeks action and excitement, treating trading like entertainment, needing constant stimulation to feel productive, confusing activity with progress, making decisions based on emotions and impulses. Fearing boredom more than losses, seeks advantage and precision, treating trading like business requiring systematic execution, comfortable with extended periods of inactivity. Understanding that patience often precedes opportunity, making decisions based on predetermined protocols and mathematical logic. Your trading edge isn't found in superior analysis, faster execution, or insider information. It exists in your ability to wait patiently for the market to prove you right through objective confirmation. Then act with mathematical precision. When all conditions align perfectly, the waiting game isn't passive, it's the most active thing you can do in markets. Conserving energy for genuine setups, where probability strongly favors success, transforming trading from emotional gambling into systematic wealth building where patience becomes your greatest competitive advantage.